Well, the S&P 500, I think, surprised a lot of investors in August because normally August, being one of the third quarter months, ends up posting a pretty weak performance. But this ended up being one of the best performances since the early 1980s. Also, we ended up with about 85% of the sub-industries in the S&P 1500 in positive territory, with most of them coming from the groups that have been beaten up the most in the most recent bear market, like leisure facilities, casinos, hotels, airlines, etc. But now that we are approaching September, which historically is the worst month by far, I think investors are using the change in the Dow composition as a reason to take some profits, but I don't think it's going to be a deep. Well, I think the international opportunities are quite large. For multiple years, the developed international indexes have dramatically underperformed the S&P 500, and that's on both a price basis, but also on a relative price to earnings ratio basis, relative PE. So I think that looking toward Japan, which is one of the largest countries with market cap, you're not having to dip into an emerging market area. You have a definite large cap arena. But at the same time, expectations are for the US dollar to weaken in 2021. So because of the very low relative price performance and valuations combined with the expectations for an even weaker US dollar, his 1% exposure based on the Berkshire Hathaway portfolio does not offer a lot of risk, but at the same time represents a nice potential. Well, I think there are an awful lot of reasons for investors to feel a little bit nervous about how far the market has advanced already. Looking at one indicator, which is a rolling 12-month differential between the S&P 500 Growth Index minus S&P 500 Value Index, we are at the highest level in history going back to the mid-1970s, so even above what we experienced at the peak of the tech bubble. But whether that bubble is going to burst in September is anyone's guess. It might end up having to wait until after the election should a Biden victory cause investors to worry that taxes could double on their investments, and as a result they look to take those profits in 2020 rather than waiting into 2021 and beyond. Well, there could be a bubble if you look at the S&P 500 Growth Index when compared with the Value Index. So essentially there are three different kinds of styles that a company within the S&P 500 could have. It's either called a growth company, it's called a blend, or it's called a value company, and it's based on a variety of metrics. Probably the best well-known is price-to-book ratio. And with technology stocks having outperformed the market over the last 1, 3, 5, 10, 25 plus years, I think investors are beginning to wonder, when will the music stop in terms of technology being such a dramatic leader? Well, you really do have to go for earnings growth expectations, valuation, etc. Low interest rates are therefore likely over the next couple of years because the Fed has told us that it now plans on looking at an average of inflation rather than targeting the specific 2% level. So with interest rates lower for longer, I think that's given investors reason to believe that they should be sticking with growth and cyclical sectors, at least for the time being, and that maybe value areas, defensive areas probably won't do as well. That said, sometimes it's best to diversify among sectors with low correlations. Consumer staples, diversifying the technology holdings has traditionally been a smart way to go. Since 1990, a combination of tech and staples has offered the same return as tech by itself, but has done so with 40% less volatility.